Now, I want to remind everybody that while we cannot control the economy, we cannot control interest rates, politics, world events, or the stock market, we can control our attitude, the activity, the pace at which we do it, the execution. So despite ongoing concerns about inflation, geopolitical tensions, tariffs, interest rates, the stock market has shown remarkable resilience. One of the biggest lessons from the past few months is that many investors sold quality assets because of fear and uncertainty. Those who stayed disciplined and focused on fundamentals were rewarded. This serves a reminder for us as business owners and business professionals, both for us as well as for our clients. And you guys know I want you to always convey the information I'm giving you here to our customers, but don't let headlines drive your decisions. Let data drive your decisions. And so what the data is telling us is that the current market expects the Fed to keep rates higher for longer. The next consumer index report is coming out on June 10th, so please make a note of that, guys. June 10th is the next CPI report coming out, and then followed by that is the Federal Reserve meeting on June 18th. So today is Tuesday, June the 2nd, so 16 days from right now, the Feds will be meeting. The expectation is that they will keep rates the same. I do not believe that anyone's going to let them raise rates because inflation is artificially, in my opinion, artificially inflated because of the price of oil, which is tied to the war in Iran, which can end at any moment, at which point fuel prices should come down and inflation should also come down. So I don't see the Feds doing anything. I think rates are going to stay parked. Now, while everyone would love lower rates, we have built our business around serving investors regardless of the rate environment. So guys, we have to talk around rates because yes, rates matter, but you got to remember something. Even in a high rates environment, people still buy houses, people still renovate houses, people still need capital, and our job is to help them succeed. I was having a conversation with my son this weekend who's 18. He's graduating this Saturday from high school. So this will be our final child out of high school, which we're all very excited about. But he said to me, he said, Dad, how are rates affecting the business and what were rates when you started buying? I said, well, Harrison, I started buying houses in 1996. And I remember one of my first buy and hold properties, I got a loan for 9.25% interest. And I was thrilled about it because some of the higher rate stuff, and this was bank financing, so this was conventional lending, this was not private or hard money, I was at 9.25. Meanwhile, some of my other peers were excited about 10.5 and 11% rates. Now, how did we absorb those rates? We negotiated better pricing, and prices are coming down. That's the thing you all have to be aware of. Prices are coming down. Foreclosure volume is rising, and when foreclosures go up, it creates this compression on the market. Those foreclosures become REOs. Those REOs sell at discounted prices. Those discounted price sales reduce the price of inventory all around, and prices go down. The other thing that you all need to be aware of, especially in the state of Washington, right now over 44 millionaires are moving out of the state of Washington every day right now. 44 millionaires a day leaving Washington. And it is creating this vacuum of properties, and it is really compressing property values. Now, right now it's only affecting the higher level property values, but you gotta understand, a lot of the property owners that are leaving Washington are taking their businesses with them, and that's going to affect people who are buying those middle tier homes, even first-time home buyers, affordable housing. This could increase the volume of motivated sales, desperate sales, and when those things begin to occur, prices fall. And the prices will always fall to accommodate the now interest rate, and we're seeing this trend. So rates continue to go up, prices will continue to go down, and eventually we'll find this normal ground. We will get there, so stay tuned. Real estate investors in high interest rate environments continue to adapt. Now, one of the encouraging trends that we're seeing nationally is that professional investors continue to adjust. The amateurs disappear, the professionals adapt, but the investors who understand creative financing, private lending, DSCR lending, seller financing, and strategic acquisitions continue to find opportunities. That's why education and funding remain such powerful businesses. Now, I would argue, I will continue to argue, and I've always argued this. If people were better educated about how to strategically buy and invest in real estate, even in high interest rate market environments, they could be getting amazing deals. We're still getting amazing deals. Our clients are still getting amazing deals because they're negotiating those seller finance type plays. Michael Roos just the other day was out working on a deal where we're looking to take over an underlying rate at like 3.5% interest. We don't care that rates are hovering at 6.8, that they're the highest that they've been since July of last year. Doesn't matter to us. Why? Because we're educated on how to buy, where to buy, what to buy, and it's the exact same education that we bring to our clients and our students. So you guys got to understand that the DSC market continues to represent one of the largest opportunities that we've ever seen. Billions of dollars are being originated every year. The broker model continues to gain traction because it scales, it requires less capital, it creates recurring opportunities, and it allows investors to build businesses around relationships. Now, our mission remains the same. Help more people understand how money works, help more people become financially free, and help more people fund deals.
If you want to learn more, just click the link below.